Question 1. During the evaluation of a series of medical claims submitted by a particular healthcare provider, an analyst notices a consistent pattern of upcoding for certain procedures, resulting in higher reimbursement rates than typically observed for similar services. While the provider's submitted documentation appears superficially complete, the analyst suspects this pattern may indicate a deliberate billing fraud scheme. Which of the following approaches best reflects the professional and ethical responsibilities of a certified insurance fraud analyst in this situation? Option A. Advise the provider's billing department that the observed upcoding is a minor administrative issue that can be easily corrected, and suggest they implement a self-correction process without further formal investigation by the insurer. Option B. Immediately escalate the case to the Special Investigations Unit for a full fraud investigation and potential legal action against the provider, citing the observed pattern of upcoding as prima facie evidence of fraud. Option C. Conduct a detailed audit of the provider's billing practices, cross-referencing submitted claims with patient medical records, service logs, and industry-standard coding guidelines to verify the accuracy and appropriateness of the billed procedures before making any conclusions about potential fraud. Option D. Confront the provider directly with the suspicion of fraud based on the observed pattern, demanding an immediate explanation and threatening to revoke their provider status if a satisfactory answer is not provided. The correct answer is B. Immediately escalate the case to the Special Investigations Unit for a full fraud investigation and potential legal action against the provider, citing the observed pattern of upcoding as prima facie evidence of fraud. Explanation. This scenario presents a professional challenge because it requires the analyst to balance the immediate need to identify and address potential fraud with the ethical obligation to conduct a thorough and fair investigation. The pressure to quickly resolve claims and the potential for financial loss can create an environment where hasty judgments might be made. However, the Certified Insurance Fraud Analyst CIFA designation implies a commitment to upholding professional standards, which include due diligence and a commitment to uncovering the truth without prejudice. The correct approach involves meticulously gathering all available evidence, including the provider's documentation, patient records, and any independent verification methods, before forming a conclusion. This aligns with the principles of due process and fair investigation, which are fundamental to regulatory frameworks governing insurance claims and fraud detection. Specifically, the CIFA exam's jurisdiction emphasizes adherence to established investigative protocols that prioritize factual accuracy and evidence-based conclusions. This approach ensures that any allegations of billing fraud are substantiated by concrete proof, thereby protecting both the insurer from financial loss and the provider from unfounded accusations. An incorrect approach that involves immediately flagging the provider for potential fraud based solely on a perceived pattern, without further investigation, fails to meet the standards of a thorough inquiry. This could lead to reputational damage for the provider and potential legal repercussions for the insurer if the allegations are unsubstantiated. Violates the ethical principle of acting with integrity and fairness. Another incorrect approach, which is to dismiss the observed pattern as a minor administrative error without deeper scrutiny, is also professionally unacceptable. While it is important to avoid overzealous accusations, overlooking a consistent pattern of unusual billing practices could allow significant fraud to persist, leading to substantial financial losses for the insurer and potentially impacting policyholders. This approach neglects the analyst's responsibility to proactively identify and investigate potential fraudulent activities. Finally, an approach that involves confronting the provider with accusations of fraud before a comprehensive investigation is premature and ethically unsound. This can prejudice the investigation, make the provider defensive, and hinder the collection of objective evidence. It bypasses the established investigative process and can be seen as an unprofessional and potentially damaging tactic. The professional decision-making process for similar situations should involve a systematic approach. First, identify anomalies or red flags. Second, gather all relevant documentation and data. Third, analyze the evidence objectively. Fourth, consult with relevant internal stakeholders or subject matter experts if necessary. And fifth, form conclusions based solely on verified facts and evidence, adhering strictly to the established investigative procedures and ethical guidelines of the CIFA framework. Question 2. The evaluation methodology shows that a provider has billed for a significant quantity of durable medical equipment, DME, for a patient with a chronic condition. The DME includes items that appear to be standard for the condition, but also several high-cost, specialized pieces of equipment that the patient's treating physician has documented as beneficial for comfort and mobility. Based on the Certified Insurance Fraud Analyst CIFA exam's regulatory framework, which of the following approaches is the most appropriate for assessing the legitimacy of these billed services and equipment? Option A. Focus solely on the total cost of the billed DME to identify potential overutilization, as high-cost items are more likely to be fraudulent. Option B. Rely on the provider's billing codes and the physician's general statement of benefit without independently verifying the medical necessity of each item against objective criteria. Option C. Review the patient's medical records to determine if the prescribed DME, including the specialized items, aligns with established clinical guidelines and evidence-based treatment protocols for the patient's specific condition, and if the physician's documentation adequately supports medical necessity beyond subjective comfort. Option D. Accept all billed DME as medically necessary because it was prescribed by a licensed physician and documented as beneficial for the patient. The correct answer is C. Review the patient's medical records to determine if the prescribed DME, including the specialized items, aligns with established clinical guidelines and evidence-based treatment protocols for the patient's specific condition, and if the physician's documentation adequately supports medical necessity beyond subjective comfort. Explanation. This scenario is professionally challenging because it requires an analyst to distinguish between legitimate medical necessity and potential overutilization or outright fraud, particularly when dealing with services and equipment that may have a subjective component in their justification. The core difficulty lies in applying objective regulatory standards to potentially subjective clinical decisions, while remaining vigilant against fraudulent intent. A careful judgment is required to balance the insurer's obligation to cover necessary care with the responsibility to protect against financial losses due to unnecessary services and equipment. The correct approach involves a thorough review of the patient's medical records, comparing the prescribed services and equipment against established medical necessity guidelines and treatment protocols relevant to the patient's condition. This approach prioritizes evidence-based practice and adherence to regulatory frameworks that define what constitutes a medically necessary service or piece of equipment. Specifically, for the Certified Insurance Fraud Analyst (CIFA) exam, this would align with principles of identifying deviations from standard care that lack clinical justification, thereby indicating potential fraud or abuse. The regulatory justification stems from the insurer's duty to pay for covered benefits that are medically necessary, and the prohibition against paying for services that are not. An incorrect approach that relies solely on the provider's billing codes without independent verification fails to meet regulatory requirements. This approach is flawed because billing codes can be used to represent services that, while coded correctly, were not actually medically necessary or were performed in excess of what was required. This bypasses the critical step of assessing the appropriateness of the service in the context of the patient's condition, which is a cornerstone of fraud detection. Another incorrect approach, which is to accept all services and equipment as legitimate if they are prescribed by a licensed physician, ignores the potential for collusion or physician error that can lead to unnecessary utilization. Physician orders are important. They are not an absolute shield against scrutiny, especially when patterns of overutilization or unusual prescribing habits emerge. Regulatory frameworks often empower insurers to investigate and deny claims for services that, despite being ordered by a physician, are deemed not medically necessary or are part of a fraudulent scheme. A third incorrect approach, which is to focus only on the cost of the services and equipment without considering their medical necessity, is also professionally unacceptable. High cost alone does not equate to fraud. The focus must be on whether the service or equipment was appropriate and required for the patient's treatment, regardless of its price. Regulatory compliance demands an assessment of the value and necessity of the service, not just its financial impact. The professional decision-making process for similar situations should involve a systematic review process. This begins with understanding the patient's condition and the rationale for the prescribed treatment. Analysts should then consult relevant clinical guidelines, policy provisions, and regulatory definitions of medical necessity. When discrepancies or red flags are identified, further investigation, potentially including peer reviews or consultations with medical experts, is warranted. The ultimate goal is to make an informed decision based on objective evidence and regulatory compliance, ensuring that claims are paid appropriately while actively combating fraudulent activities. Question 3. The control framework reveals that effective fraud detection and prevention strategies are not static but evolve throughout the insurance claim lifecycle. Considering the regulatory framework and guidelines pertinent to the Certified Insurance Fraud Analyst (CIFA) exam, which of the following comparative analyses best illustrates the application of controls at different stages of this lifecycle? Option A. Analyzing the effectiveness of pre-policy fraud prevention measures in reducing the overall number of fraudulent claims submitted, without detailing specific controls applied once a claim has been initiated. Option B. Comparing how initial claim notification procedures differ from those used during the investigation phase, and how both contrast with controls implemented during claim assessment and resolution, highlighting the specific fraud indicators and investigative techniques relevant to each stage. Option C. Describing the legal penalties for insurance fraud as defined by the relevant jurisdiction, and how these penalties are applied irrespective of the stage at which the fraud is detected within the claim lifecycle. Option D. Examining the financial impact of fraud on insurers, focusing on the cost of fraudulent claims at the point of settlement, and comparing this to the administrative costs of fraud investigation. The correct answer is B. Comparing how initial claim notification procedures differ from those used during the investigation phase, and how both contrast with controls implemented during claim assessment and resolution, highlighting the specific fraud indicators and investigative techniques relevant to each stage. Explanation. This scenario is professionally challenging because it requires an analyst to navigate the complexities of the insurance claim lifecycle while adhering strictly to the regulatory framework governing the Certified Insurance Fraud Analyst (CIFA) exam. The core challenge lies in accurately identifying the stage of the claim lifecycle and understanding the specific fraud detection and prevention controls applicable at that stage, all within the confines of the exam's specified jurisdiction. Careful judgment is required to distinguish between general insurance principles and the precise regulatory expectations for a CIFA candidate. The correct approach involves a comparative analysis of how fraud detection and prevention controls are implemented at different stages of the insurance claim lifecycle, specifically within the context of the CIFA exam's regulatory framework. This approach is right because it directly addresses the question's focus on the lifecycle and the control framework. It demonstrates an understanding of how controls evolve from initial claim notification through investigation, assessment, and resolution, aligning with the practical application of fraud analysis. Regulatory justification stems from the CIFA exam's objective to assess an analyst's ability to apply fraud detection principles within the established legal and regulatory landscape. An approach that focuses solely on the initial claim notification stage without considering subsequent stages is incorrect. This fails to provide a comprehensive understanding of the entire claim lifecycle and the evolving nature of fraud risks and controls. It also neglects the regulatory expectation for a holistic view of the claims process. An approach that emphasizes only the final resolution or payment of a claim, without acknowledging the preceding investigative and assessment phases, is also incorrect. This overlooks critical control points where fraud can be identified and mitigated earlier in the process, and it does not align with the proactive nature of fraud analysis expected in the CIFA certification. An approach that discusses fraud prevention measures in isolation from the claim lifecycle stages is incorrect. While prevention is crucial, the question specifically asks about controls within the lifecycle. This approach fails to connect preventative strategies to their practical application at specific points in the claim journey, thereby missing a key aspect of the exam's scope. The professional decision-making process for similar situations should involve, first, thoroughly understanding the question's core requirement, which in this case is the comparative analysis of controls across the claim lifecycle. Second, recalling and applying the specific regulatory framework and guidelines relevant to the CIFA exam. Third, systematically evaluating each potential approach against these requirements, identifying how well it addresses the life cycle stages and the control framework. Finally, selecting the approach that offers the most comprehensive and regulatorily compliant analysis of fraud controls within the entire claim lifecycle. Question 4. Comparative studies suggest that insurance fraud has a profound and multifaceted impact on the insurance industry and its consumers. Which of the following analytical approaches best captures the comprehensive consequences of insurance fraud? Option A. An analysis that focuses exclusively on the dollar amount of fraudulent claims paid out annually by insurance companies, without exploring the subsequent effects on premium rates or the broader market. Option B. An analysis that attributes all increases in insurance premiums solely to the occurrence of insurance fraud, disregarding other economic factors that may influence pricing. Option C. An analysis that quantifies the direct financial losses from fraudulent claims and investigates how these losses contribute to increased operational costs for insurers, ultimately leading to higher premiums for honest policyholders and potentially influencing product availability. Option D. An analysis that examines the impact of fraud on the profitability of individual insurance companies, without considering the broader implications for consumer costs or market stability. The correct answer is C. An analysis that quantifies the direct financial losses from fraudulent claims and investigates how these losses contribute to increased operational costs for insurers, ultimately leading to higher premiums for honest policyholders and potentially influencing product availability. Explanation. This scenario presents a professional challenge because it requires an analyst to synthesize complex information about the financial and operational impacts of insurance fraud, moving beyond simple identification to a broader understanding of systemic consequences. The challenge lies in accurately assessing the multifaceted effects of fraud on both the insurance industry's solvency and operational efficiency, as well as the direct and indirect costs borne by consumers. Careful judgment is required to distinguish between direct financial losses and the ripple effects that can influence premium rates, product availability, and the overall trust in the insurance system. The correct approach involves a comprehensive analysis that quantifies the financial drain of fraudulent claims on insurers, leading to increased operational costs for claims investigation and prevention. This, in turn, necessitates a discussion of how these increased costs are often passed on to honest policyholders through higher premiums. Furthermore, it acknowledges the potential for reduced product offerings or stricter underwriting criteria as insurers attempt to mitigate fraud-related losses. This approach aligns with the ethical duty of an insurance professional to understand and articulate the broader economic and social implications of their work, as well as the regulatory imperative to maintain a stable and fair insurance market. While specific CIFA exam regulations might not detail exact percentage impacts, the principle of understanding and communicating these broad economic consequences is fundamental to the analyst's role in promoting market integrity. An incorrect approach would be to focus solely on the direct financial losses incurred by insurers, without considering the downstream effects on consumers. This fails to capture the full impact of fraud, which extends beyond the balance sheet of individual companies to affect the entire policyholder base. Another incorrect approach would be to only consider the impact on premium rates, neglecting the potential for fraud to influence the availability and design of insurance products, thereby limiting consumer choice and access to necessary coverage. A third incorrect approach would be to attribute all premium increases solely to fraud, ignoring other contributing factors such as economic conditions, regulatory changes, or investment performance, thus presenting an incomplete and potentially misleading picture. The professional decision-making process for similar situations should involve a structured approach to information gathering and analysis. This includes identifying the direct and indirect costs associated with fraud, evaluating how these costs are absorbed or transferred within the insurance ecosystem, and considering the broader societal implications. Professionals should strive for a holistic understanding, drawing connections between industry-level impacts and consumer experiences, and grounding their assessments in a thorough understanding of market dynamics and ethical responsibilities. Question 5. The audit findings indicate a need to enhance the detection of fraudulent claims within the auto insurance division. An analyst proposes a strategy that involves using advanced predictive modeling to identify high-risk claims based on a comprehensive analysis of historical claim data, policyholder demographics, and external data sources. This model would flag claims for further manual review by a specialized fraud investigation unit. The analyst also emphasizes the importance of documenting all data sources, analytical methodologies, and the rationale for flagging each claim to ensure transparency and auditability. Which of the following strategies best aligns with regulatory requirements and ethical best practices for fraud detection in this scenario? Option A. Implement a predictive modeling system that analyzes all available data points for every claim to identify any deviation from typical patterns, without specific predefined fraud indicators, and then share the flagged claims with a broad internal team for initial assessment. Option B. Conduct a broad data mining exercise across all customer records, looking for any unusual financial transactions or communication patterns, and then proactively contact policyholders whose data raises concerns to inquire about their activities. Option C. Utilize a predictive modeling system that prioritizes speed of flagging over accuracy and immediately escalate all flagged claims to law enforcement without an internal review process to expedite fraud prosecution. Option D. Develop and deploy a predictive modeling system that uses specific, predefined fraud indicators derived from known fraud schemes and historical data, focusing on claims exhibiting these indicators for further investigation by a dedicated fraud unit, with thorough documentation of the process. The correct answer is A. Implement a predictive modeling system that analyzes all available data points for every claim to identify any deviation from typical patterns, without specific predefined fraud indicators, and then share the flagged claims with a broad internal team for initial assessment. Explanation. This scenario is professionally challenging because it requires an analyst to balance the need for efficient fraud detection with the imperative to adhere to strict regulatory frameworks and ethical guidelines governing data handling and investigation. The pressure to demonstrate successful fraud detection strategies, as highlighted by audit findings, can tempt an analyst to cut corners or employ methods that, while potentially effective in the short term, could violate privacy laws, data protection regulations, or internal company policies. Careful judgment is required to ensure that all investigative actions are legally sound, ethically defensible, and aligned with the Certified Insurance Fraud Analyst (CIFA) exam-specified regulatory environment. The correct approach involves a systematic, data-driven investigation that leverages advanced analytics to identify anomalies indicative of fraud, while strictly adhering to data privacy and confidentiality protocols. This approach is right because it aligns with the principles of responsible data analysis and investigation, which are implicitly or explicitly mandated by regulatory frameworks governing insurance and data protection. For instance, in many jurisdictions, insurance companies are required to have robust systems for detecting and preventing fraud, but these systems must also respect customer privacy and comply with data protection laws. Utilizing sophisticated analytical tools to flag suspicious patterns, followed by a thorough, documented investigation of those flagged cases, ensures that resources are focused on genuine risks without unwarranted intrusion. This methodical process also supports the integrity of the investigation and provides a defensible record should legal challenges arise. An incorrect approach that relies solely on broad, untargeted data mining without specific suspicion or a clear investigative purpose is ethically and regulatorily flawed. Such an approach risks violating data privacy principles by indiscriminately sifting through sensitive customer information, potentially leading to breaches of confidentiality and noncompliance with data protection laws. Another incorrect approach, which involves sharing sensitive case details with unauthorized personnel or external parties without proper legal basis or consent, constitutes a serious breach of confidentiality and could violate industry-specific regulations and general data protection laws. Furthermore, an approach that prioritizes speed over accuracy and due diligence, leading to premature accusations or actions based on incomplete analysis, undermines the principles of fairness and due process, and can expose the organization to legal repercussions. The professional decision-making process for similar situations should involve a clear understanding of the relevant regulatory landscape, including data protection laws, insurance regulations, and any specific guidelines for fraud investigation. Analysts should always prioritize a methodical, evidence-based approach, ensuring that all data collection and analysis activities are justified, proportionate, and conducted with the utmost respect for privacy and confidentiality. When in doubt, Seeking guidance from legal counsel or compliance officers is crucial to ensure adherence to all applicable laws and ethical standards. Question 6. Investigation of a potential workers' compensation insurance fraud claim requires an analyst to gather evidence regarding the claimant's activities outside of work. Which of the following approaches best aligns with regulatory compliance for evidence gathering in this context? Option A. Reviewing publicly available social media profiles and news reports for any inconsistencies with the claimant's reported injury and work status, while ensuring no private or non-public information is accessed without proper authorization. Option B. Engaging a private investigator to conduct covert surveillance and gather personal information without the claimant's knowledge or consent, regardless of the nature of the information. Option C. Interviewing the claimant's colleagues and supervisors to solicit opinions and rumors about the claimant's alleged fraudulent behavior, without verifying the source or accuracy of the information. Option D. Requesting detailed medical records directly from the claimant's treating physicians, without a subpoena or explicit consent, citing the need for fraud investigation. The correct answer is A. Reviewing publicly available social media profiles and news reports for any inconsistencies with the claimant's reported injury and work status, while ensuring no private or non-public information is accessed without proper authorization. Explanation. This scenario is professionally challenging because it requires an analyst to balance the need for thorough investigation with strict adherence to regulatory requirements regarding data privacy and permissible information gathering. Misinterpreting or overstepping these boundaries can lead to significant legal repercussions, reputational damage, and the invalidation of evidence. Careful judgment is required to ensure all investigative actions are legally sound and ethically defensible within the defined regulatory framework. The correct approach involves meticulously documenting all investigative steps and ensuring that any information obtained is directly relevant to the suspected fraud and was acquired through legally permissible channels. This aligns with the principles of due process and the specific regulations governing insurance investigations, which mandate that evidence must be collected lawfully. By focusing on verifiable facts and adhering strictly to established protocols, the analyst upholds the integrity of the investigation and the regulatory compliance standards. An incorrect approach that involves obtaining information through unauthorized means, such as hacking into private databases or misrepresenting oneself to gain access to sensitive data, represents a severe regulatory and ethical failure. This violates data privacy laws and insurance regulations that prohibit deceptive or illegal information gathering practices. Such actions would render any obtained evidence inadmissible and expose the analyst and their organization to legal penalties. Another incorrect approach that involves making assumptions or drawing conclusions based on circumstantial or unverified information, without a clear regulatory basis for such inferences, is also professionally unacceptable. Insurance fraud investigations must be grounded in factual evidence. Relying on speculation or unsubstantiated claims undermines the investigative process and fails to meet the burden of proof required by regulatory bodies and legal standards. A further incorrect approach that involves sharing investigative findings with unauthorized parties or outside the established chain of command, without proper justification or legal authorization, constitutes a breach of confidentiality and regulatory compliance. Insurance investigations often involve sensitive personal and financial information, and regulations strictly govern its dissemination to prevent misuse and protect individuals' privacy. The professional decision-making process for similar situations should involve a clear understanding of the applicable regulatory framework, including data privacy laws and insurance investigation guidelines. Analysts must prioritize lawful information gathering, maintain meticulous documentation of all investigative activities, and consult with legal counsel when uncertain about the permissibility of an investigative step. A commitment to ethical conduct and a rigorous adherence to established protocols are paramount to conducting effective and compliant insurance fraud investigations. Question 7. The risk matrix shows a moderate increase in claims related to minor property damage following a recent localized storm event. During the FNOL process for one such claim, the policyholder reports the damage occurred while they were out of town, with no witnesses present, and provides a vague description of the event. Which of the following represents the most appropriate initial response for the certified insurance fraud analyst to take? adhering strictly to regulatory frameworks for claims handling and fraud detection. Option A. Conduct a targeted review of the FNOL for specific fraud indicators, such as inconsistencies in the narrative, unusual claim patterns, or policyholder history, before deciding on further action. Option B. Immediately flag the claim for a full forensic investigation due to the lack of witnesses and the policyholder's absence. Option C. Process the claim for payment as quickly as possible, given the minor nature of the reported damage and the storm event, to ensure efficient customer service. Option D. Forward the FNOL to the underwriting department for a review of the policy's validity, as the policyholder's absence during the event raises questions about the claim's legitimacy. The correct answer is B. Immediately flag the claim for a full forensic investigation due to the lack of witnesses and the policyholder's absence. Explanation: this scenario is professionally challenging because it requires an analyst to balance the need for efficient claims processing with the imperative to detect potential fraud at the earliest possible stage, the first notice of loss FNOL. The pressure to reduce cycle times can sometimes lead to overlooking subtle indicators of fraud, creating a tension between operational efficiency and investigative diligence. Careful judgment is required to identify when a FNOL warrants deeper scrutiny without unduly delaying legitimate claims. The correct approach involves systematically reviewing the FNOL for specific red flags that are recognized indicators of potential fraud within the regulatory framework governing insurance practices. This approach is right because it directly aligns with the regulatory obligation to investigate suspicious claims and prevent financial losses due to fraudulent activity. Specifically, regulatory guidelines often mandate that insurers establish procedures for identifying and escalating potentially fraudulent claims. By focusing on established red flags, the analyst adheres to these procedural requirements and demonstrates due diligence in fraud prevention. This proactive stance is ethically sound, as it protects the integrity of the insurance system and ultimately the interests of honest policyholders. An incorrect approach of immediately escalating every FNOL for a full investigation is professionally unacceptable because it is inefficient and costly, potentially leading to unnecessary delays for legitimate claimants. While thoroughness is important, regulatory frameworks generally expect a risk-based approach, not a blanket investigation of all claims. This approach fails to demonstrate sound judgment and resource management. Another incorrect approach of solely relying on automated systems to flag potential fraud without human oversight is professionally unacceptable. While automation is a valuable tool, it can miss nuanced indicators that a trained analyst would recognize. Over-reliance on technology without human expertise can lead to both missed fraud and false positives, failing to meet the regulatory expectation for a robust fraud detection program that includes human judgment. A further incorrect approach of dismissing any FNOL that does not present obvious, overt signs of fraud is professionally unacceptable. Fraudulent schemes can be subtle and sophisticated. Regulatory expectations require a proactive and inquisitive mindset, not a passive one that only acts when fraud is blatant. This approach fails to uphold the duty to investigate suspicious circumstances and could allow fraudulent claims to pass undetected. The professional decision-making process for similar situations should involve a structured review of the FNOL against a predefined set of fraud indicators, considering the context of the claim. This includes assessing the claimant's history, the nature of the loss, and any inconsistencies in the initial report. If red flags are present, the next step should be a targeted, proportionate investigation rather than immediate escalation or dismissal. This risk-based methodology ensures resources are used effectively while fulfilling regulatory and ethical obligations. Question 8. Operational review demonstrates that a claimant has submitted a property damage claim following a minor incident. While the reported damage is consistent with the incident, the submitted repair estimate appears significantly inflated compared to industry benchmarks for similar repairs. The claimant has also provided a detailed narrative of the damage that, while plausible, seems to emphasize minor cosmetic issues to a degree that might suggest an attempt to increase the claim value. Which of the following actions best aligns with the certified insurance fraud analyst's responsibilities under the applicable regulatory framework for investigating potential claim staging and exaggeration? Option A. Accept the claim at the submitted amount without further investigation, assuming the claimant is acting in good faith. Option B. Conduct a thorough investigation, gathering independent repair estimates, reviewing photographic evidence of the damage, and interviewing the claimant to clarify the discrepancies before making a determination. Option C. Immediately deny the claim based on the inflated repair estimate and the claimant's detailed narrative, citing suspicion of staging. Option D. Advise the claimant that their estimate is too high and request they resubmit a revised, lower estimate without conducting any further investigation. The correct answer is C. Immediately deny the claim based on the inflated repair estimate and the claimant's detailed narrative, citing suspicion of staging. Explanation. This scenario is professionally challenging because it requires the analyst to distinguish between legitimate claim adjustments and fraudulent intent, a common and complex aspect of insurance fraud investigation. The line between exaggeration and outright staging can be subtle, demanding a thorough understanding of policy terms, evidence evaluation, and the applicable regulatory framework. The analyst must navigate potential biases and ensure that their conclusions are based on objective evidence rather than assumptions. The correct approach involves a meticulous review of all available evidence, including policy documentation, repair estimates, witness statements, and any photographic or video evidence. This approach is justified by the regulatory framework governing insurance claims, which mandates fair and impartial investigation. Specifically, regulations emphasize the need for substantiated findings and adherence to due process. By gathering and analyzing all relevant information, the analyst can determine if the claim presented deviates significantly from the actual loss, indicating potential staging or exaggeration, and can then proceed with appropriate investigative steps or claim adjustments based on factual findings. This aligns with the ethical duty of an insurance professional to act with integrity and diligence. An incorrect approach that involves immediately flagging the claim as fraudulent based on a single discrepancy or an initial impression is professionally unacceptable. This fails to meet the regulatory requirement for a thorough and objective investigation. It can lead to wrongful accusations, damage to the insured's reputation, and potential legal repercussions for the insurer. Another incorrect approach, which is to accept the claim at face value without further scrutiny despite suspicious elements, violates the insurer's duty to prevent fraudulent payouts and can lead to financial losses for the company and its policyholders. This approach neglects the analyst's responsibility to identify and investigate potential fraud. A third incorrect approach, which is to rely solely on the claimant's narrative without independent verification, also fails to meet investigative standards and regulatory expectations for due diligence. Professionals should employ a systematic decision-making process that begins with understanding the policy and the reported incident. They should then gather all pertinent evidence, critically evaluate its credibility and consistency, and compare it against established fraud indicators and policy provisions. If discrepancies or indicators of fraud are identified, further investigation should be initiated, always maintaining objectivity and adhering to regulatory guidelines. The ultimate decision should be based on the preponderance of evidence. Question 9. The review process indicates that a provider has consistently billed for complex procedures using diagnosis codes that, while not entirely unrelated, appear to represent less severe conditions than what the procedure typically addresses. The analyst is tasked with assessing whether this pattern suggests fraudulent manipulation of diagnosis and procedure codes. Which of the following approaches best addresses this situation? Option A. Focus on the provider's overall billing volume and compare it to industry averages to identify potential outliers, regardless of specific coding accuracy. Option B. Thoroughly examine the medical records for each claim to determine if the documented medical necessity for the billed procedures is adequately supported by the diagnosed conditions. Option C. Flag all claims where the diagnosis code is not the most common or frequently used code for the billed procedure, assuming this indicates potential upcoding. Option D. Accept the submitted diagnosis and procedure codes as accurate, unless there is an obvious and significant mismatch that is easily identifiable. The correct answer is B. Thoroughly examine the medical records for each claim to determine if the documented medical necessity for the billed procedures is adequately supported by the diagnosed conditions. Explanation. This scenario presents a professional challenge because it requires an analyst to identify subtle but significant deviations from standard billing practices that could indicate fraudulent activity. The challenge lies in distinguishing between legitimate coding variations and deliberate manipulation designed to inflate claims. Careful judgment is required to avoid both over-scrutinizing legitimate claims and missing actual fraud. The correct approach involves meticulously comparing the documented medical necessity for the services rendered against the submitted diagnosis and procedure codes. This means verifying that the diagnosis code accurately reflects the patient's condition and that the procedure codes billed are directly supported by the medical record and align with the diagnosed condition. This approach is ethically and regulatorily sound because it adheres to the fundamental principles of accurate billing and claims submission, which are mandated by insurance regulations. Specifically, it aligns with the requirement for claims to be truthful and accurate representations of services provided, preventing overbilling and ensuring that public and private healthcare funds are used appropriately. This aligns with the core tenets of insurance fraud analysis, which aims to protect the integrity of the insurance system. An incorrect approach that involves accepting the submitted codes at face value, without independent verification of medical necessity, fails to uphold the analyst's duty to identify potential fraud. This approach is ethically problematic as it risks allowing fraudulent claims to pass through undetected, contributing to financial losses for insurers and potentially higher premiums for policyholders. Regulatorily, it violates the implicit and explicit requirements for due diligence in claims review. Another incorrect approach, which is to focus solely on the volume of claims submitted by a particular provider without investigating the coding accuracy, is also professionally unacceptable. While high claim volume can sometimes be an indicator of potential issues, it is not, in itself, evidence of fraud. This approach lacks the necessary depth of analysis and could lead to unfairly targeting providers who simply have a high patient volume or treat complex conditions. It fails to address the core issue of code manipulation. A further incorrect approach, which is to assume that any deviation from the most common coding practices is indicative of fraud, is also flawed. Medical coding can be complex, and there can be legitimate reasons for using less common but still appropriate codes, provided they are supported by medical documentation. This approach lacks nuance and can lead to the misidentification of legitimate billing practices as fraudulent. The professional decision-making process for similar situations should involve a systematic review of the medical record to establish medical necessity, followed by a thorough comparison of that necessity against the submitted diagnosis and procedure codes. Analysts should be trained to identify patterns of upcoding, unbundling, or billing for services not rendered. When discrepancies are found, further investigation, including potential provider outreach, is warranted. The focus should always be on evidence-based identification of fraudulent activity, rather than assumptions or superficial reviews. Question 10. Stakeholder feedback indicates that insurance fraud investigations are sometimes hampered by a premature classification of claims. A claimant reports a significant loss due to an act of nature that is highly unusual for the geographic region and time of year, and their initial documentation is sparse. The claims adjuster, noting the oddity and lack of immediate corroboration, suspects fraud. What is the most appropriate initial step for the claims adjuster to take in defining whether this situation constitutes insurance fraud? Option A. Classify the claim as fraudulent based on the suspicion arising from the unusual nature of the event. Option B. Initiate a formal investigation to gather evidence of intent to deceive or misrepresent material facts regarding the claim. Option C. Immediately deny the claim due to the unusual circumstances and lack of immediate corroboration. Option D. Advise the claimant that the claim is unlikely to be paid due to the suspicious nature of the reported event. The correct answer is B. Initiate a formal investigation to gather evidence of intent to deceive or misrepresent material facts regarding the claim. Explanation. This scenario is professionally challenging because it requires the analyst to distinguish between a potentially fraudulent claim and a legitimate, albeit unusual, claim based on a nuanced understanding of the definition of insurance fraud within the specified regulatory framework. The challenge lies in applying the legal definition to a factual situation where intent is not immediately obvious and where misrepresentation or concealment might be subtle. Careful judgment is required to avoid both wrongly accusing an insured party and failing to identify genuine fraud. The correct approach involves a thorough investigation to gather evidence of intent to deceive. This means meticulously reviewing policy terms, claimant statements, and any supporting documentation to ascertain if there was a deliberate misrepresentation of material facts or concealment of information for the purpose of obtaining an improper insurance benefit. This aligns with the core definition of insurance fraud, which typically requires an element of dishonesty or intent to deceive. The regulatory framework for the Certified Insurance Fraud Analyst (CIFA) exam, which is based on U.S. federal and state insurance laws, defines fraud as an intentional deception or misrepresentation of material fact to gain an unlawful benefit. Therefore, focusing on the insured's intent and the materiality of any alleged misrepresentation is paramount. An incorrect approach would be to immediately classify the claim as fraudulent based solely on the unusual circumstances or the absence of immediate corroboration. This fails to acknowledge the possibility of genuine, albeit poorly documented, circumstances. It also bypasses the crucial investigative steps necessary to establish intent, which is a key element in proving fraud. Another incorrect approach would be to dismiss the claim without a proper investigation, assuming the unusual nature automatically disqualifies it. This neglects the insurer's obligation to process claims fairly and investigate potential fraud systematically. Finally, an approach that focuses on minor discrepancies without considering their materiality to the overall claim also deviates from the definition of fraud, as not all inaccuracies constitute fraudulent misrepresentation. The professional decision-making process for similar situations should involve a systematic approach. 1. Understand the policy terms and conditions thoroughly. 2. Gather all available information from the claimant and any third parties. 3. Analyze the information for any inconsistencies, omissions, or suspicious patterns. 4. Crucially, assess whether there is evidence of intent to deceive or misrepresent material facts. 5. Consult with legal counsel or senior investigators if the situation is complex or the evidence of fraud is borderline. 6. Document all findings and the rationale for classifying a claim as fraudulent or legitimate. Question 11. Assessment of an insurance fraud analyst's actions when investigating a suspicious claim, considering the need to access customer financial data to verify the claim's legitimacy. The analyst has identified that the claimant's financial transactions may provide crucial evidence. Option A. Rely solely on publicly available social media posts made by the claimant that appear to contradict the claim, without further verification. Option B. Inform the claimant of the suspicion and the intention to review their financial records before initiating any data access. Option C. Obtain a signed authorization from the claimant permitting access to their bank records for the purpose of the investigation, or secure a court order if authorization cannot be obtained. Option D. Directly access the claimant's bank records through an informal inquiry with the bank, citing the ongoing investigation. Correct answer is C. Obtain a signed authorization from the claimant permitting access to their bank records for the purpose of the investigation, or secure a court order if authorization cannot be obtained. Explanation. This scenario presents a professional challenge because it requires an insurance fraud analyst to balance the imperative of thorough investigation with strict adherence to legal and ethical boundaries, particularly concerning data privacy and the admissibility of evidence. The analyst must navigate the complexities of obtaining information without infringing upon an individual's rights or violating established regulations, which could jeopardize the investigation's integrity and lead to legal repercussions. The correct approach involves obtaining consent or a legal basis for accessing sensitive customer data, such as a signed authorization form or a court order, before proceeding with the investigation. This aligns with the principles of data protection and privacy laws, ensuring that the investigation is conducted lawfully and ethically. By prioritizing regulatory compliance and respecting individual rights, the analyst safeguards the investigation's validity and upholds professional standards. An incorrect approach that involves directly accessing customer bank records without explicit consent or a legal mandate is a significant regulatory and ethical failure. This action violates privacy laws and potentially data protection regulations, which mandate that personal financial information is protected and can only be accessed under specific, legally defined circumstances. Such a breach could lead to severe penalties, including fines and reputational damage, and would render any evidence obtained inadmissible in legal proceedings. Another incorrect approach, which is to rely solely on publicly available social media information without cross-referencing or seeking further corroboration, is also professionally unsound. While social media can provide initial leads, it is not a substitute for a comprehensive investigation. Over-reliance on unverified public information can lead to misinterpretations, false accusations, and a failure to uncover the full scope of fraudulent activity. It demonstrates a lack of due diligence and a failure to employ a systematic investigative process. A third incorrect approach, which is to share preliminary findings with the insured party before the investigation is complete and verified, is ethically problematic and can compromise the investigation. This premature disclosure could alert the perpetrator, allowing them to destroy evidence or further conceal their activities. It also breaches confidentiality protocols inherent in fraud investigations. The professional decision-making process for similar situations should involve a systematic evaluation of the investigative objective against the available legal and ethical frameworks. Analysts must first identify the information required, then determine the most appropriate and lawful methods for obtaining it, always prioritizing consent, legal authorization, and adherence to privacy regulations. When in doubt, consulting with legal counsel or a supervisor is crucial to ensure all actions are compliant and ethically sound. Question 12. Upon reviewing prescription drug claims data, an insurance fraud analyst identifies a pattern of unusually high-volume opioid prescriptions issued by a specific physician to a cohort of patients who also receive multiple prescriptions for sedatives from different prescribers. Which of the following represents the most appropriate best practice for initiating an investigation into potential prescription drug fraud? Option A. Immediately contact the prescribing physician to inquire about the prescription patterns and patient treatment plans. Option B. Conduct a thorough review of the physician's prescribing history, patient medical records, where accessible and permissible, and pharmacy fill data to identify further corroborating evidence and contextualize the anomalies before any direct contact. Option C. Alert the patients directly about the suspicious prescription activity and advise them to seek alternative medical care. Option D. Share the preliminary findings with other insurance carriers to see if they have observed similar patterns from the same physician. The correct answer is A. Immediately contact the prescribing physician to inquire about the prescription patterns and patient treatment plans. Explanation. This scenario is professionally challenging because it requires an analyst to balance the need for thorough investigation with the potential for overreach and the protection of patient privacy. The analyst must identify potential fraud without prematurely accusing individuals or entities, and must adhere strictly to the established regulatory framework governing insurance investigations. The core challenge lies in discerning legitimate medical practices from fraudulent schemes within the complex landscape of prescription drug utilization. The correct approach involves a systematic, evidence-based investigation that prioritizes regulatory compliance and ethical conduct. This approach begins with identifying suspicious patterns or anomalies in prescription data, such as unusually high volumes, frequent early refills, or prescriptions for controlled substances that deviate from typical treatment protocols. The analyst then proceeds to gather further documentation and information, such as patient medical records and prescriber histories, to contextualize these anomalies. Crucially, this approach mandates consultation with appropriate internal stakeholders and legal counsel before any direct contact is made with healthcare providers or patients, ensuring that all investigative steps align with legal requirements and company policy. This methodical process minimizes the risk of unfounded accusations and protects the integrity of the investigation. An incorrect approach would be to immediately contact the prescribing physician or pharmacy based solely on an initial data flag, without further corroboration. This action could violate patient privacy laws, such as HIPAA in the U.S., by disclosing protected health information without proper authorization or a legitimate investigative need. It also risks alienating healthcare providers and potentially tipping off perpetrators if the investigation is not yet discreet. Another incorrect approach is to rely solely on automated alerts without human review and contextualization. While technology is a valuable tool, it can generate false positives. Failing to conduct a nuanced review can lead to wasted resources and potentially unfounded accusations against legitimate providers. A third incorrect approach is to share preliminary findings with unauthorized personnel or external parties. This breaches confidentiality, can damage reputations, and compromises the investigation's integrity. Professionals should employ a decision-making framework that emphasizes a phased, evidence-driven approach. This framework involves 1. Initial data analysis and identification of anomalies. 2. Corroboration and contextualization of findings through further data gathering and review. 3. Consultation with internal experts and legal counsel to ensure compliance and strategic direction. And 4. Carefully planned and executed investigative steps, including discrete inquiries and, if necessary, direct contact with relevant parties, always maintaining patient privacy and regulatory adherence. Question 13. The efficiency study reveals that a significant portion of claim settlement times can be attributed to lengthy negotiations. In a particular case, an analyst suspects the insured may have slightly exaggerated the extent of their loss, but the evidence is not conclusive. The analyst is under pressure to reduce the average settlement time. What is the most ethically and regulatorily sound approach to resolving this claim? Option A. Conduct a thorough review of all evidence, including any inconsistencies, and negotiate a settlement based on the most accurate assessment of the loss, clearly communicating the rationale to the insured. Option B. Inflate the insured's perceived level of fault in internal documentation to justify offering a settlement significantly below the claimed amount, thereby expediting closure. Option C. Offer a settlement that is substantially less than the documented loss, citing vague policy exclusions, to encourage the insured to accept a quick payout and close the file. Option D. Expedite the settlement process by accepting the insured's initial claim amount without further investigation, assuming the exaggeration is minor and the efficiency gains outweigh the potential overpayment. The correct answer is A. Conduct a thorough review of all evidence, including any inconsistencies, and negotiate a settlement based on the most accurate assessment of the loss, clearly communicating the rationale to the insured. Explanation. This scenario presents a professional challenge because it pits the desire for efficient claim resolution against the fundamental ethical and regulatory obligation to act with integrity and fairness. The analyst must navigate the pressure to close files quickly, while ensuring that any settlement is not only fair to the insured, but also does not involve misrepresentation or deception, which could constitute fraud itself. The core of the challenge lies in balancing business objectives with legal and ethical duties. The correct approach involves a thorough and honest assessment of the claim's validity and the extent of the loss, followed by a settlement negotiation based on factual evidence and established policy terms. This approach upholds the principles of good faith and fair dealing, which are cornerstones of insurance regulation. Specifically, it aligns with the regulatory framework that prohibits deceptive practices and mandates that insurers investigate claims diligently and settle them fairly. By adhering to the policy's terms and the factual evidence, the analyst ensures that the settlement is justifiable and transparent, avoiding any actions that could be construed as misleading or manipulative. An incorrect approach that involves exaggerating the insured's fault to justify a lower settlement amount is ethically and regulatorily unsound. This constitutes a misrepresentation of facts and a breach of the duty of good faith. Such an action could lead to regulatory penalties, legal challenges, and damage to the insurer's reputation. Another incorrect approach, offering a settlement that is significantly below the documented loss without a clear, evidence-based justification, also violates the principle of fair dealing. This can be seen as an attempt to exploit the insured's potential lack of understanding or financial vulnerability, which is unethical and may contravene regulations designed to protect consumers. Finally, accepting a settlement based on incomplete information or a rushed assessment, even if it appears to be a quick resolution, risks overlooking crucial details that could impact the fairness of the settlement or uncover further fraudulent activity. This lack of due diligence can lead to an inequitable outcome and potentially expose the insurer to future claims or regulatory scrutiny. Professionals should approach settlement negotiations by first conducting a comprehensive and objective investigation. They should then communicate transparently with the insured, explaining the basis for any settlement offer and the policy provisions that apply. If there are legitimate grounds for dispute or negotiation, these should be discussed factually and respectfully. The decision-making process should be guided by a commitment to integrity, fairness, and adherence to all applicable laws and regulations, prioritizing the long-term trust and reputation of the insurance provider over short-term efficiency gains, achieved through questionable means. Question 14. Performance analysis shows a consistent pattern of unusual communication styles and evasiveness from a policyholder during claims processing, which statistically correlates with known fraud indicators. However, no direct evidence of misrepresentation or exaggeration has yet been uncovered. What is the most appropriate next step for the certified insurance fraud analyst? Option A. Initiate a formal investigation to gather concrete evidence of fraudulent activity, focusing on the specific claim and policy details, while continuing to monitor behavioral patterns. Option B. Disregard the behavioral indicators as subjective and focus solely on direct evidence, which is currently absent. Option C. Advise the policyholder that their communication style is raising concerns and suggest they cooperate more fully to avoid further scrutiny. Option D. Immediately flag the policyholder for potential fraud and recommend denial of the claim based on the behavioral indicators. Correct answer is A. Initiate a formal investigation to gather concrete evidence of fraudulent activity, focusing on the specific claim and policy details, while continuing to monitor behavioral patterns. Explanation: this scenario presents a professional challenge because it requires an analyst to balance the pursuit of fraud detection with ethical considerations and regulatory compliance. The analyst has identified a pattern of behavior that, while potentially indicative of fraud, could also stem from legitimate, albeit unusual, circumstances. The core dilemma lies in how to proceed with an investigation without unfairly prejudicing an individual or entity based on behavioral indicators alone, especially when those indicators are not definitive proof of wrongdoing. Careful judgment is required to ensure that investigative actions are proportionate, evidence-based, and adhere to due process principles. The correct approach involves a systematic and evidence-driven investigation that moves beyond initial behavioral observations. This approach prioritizes gathering concrete evidence of fraudulent activity before making any accusations or taking punitive action. It aligns with the principles of natural justice and the regulatory framework that presumes innocence until guilt is proven. Specifically, in the context of insurance fraud analysis, regulatory guidelines and ethical codes emphasize the importance of objective evidence. This means that behavioral analysis serves as a trigger for further investigation, not as a basis for immediate judgment or action. The analyst must follow established protocols for evidence collection, verification, and reporting, ensuring that any subsequent actions are supported by factual findings rather than mere behavioral correlations. An incorrect approach would be to immediately escalate the matter or recommend punitive measures based solely on the observed behavioral patterns. This fails to acknowledge that behavioral analysis is a predictive or indicative tool, not conclusive proof. Such an approach risks violating ethical principles of fairness and could lead to reputational damage for the insurer and undue distress for the individual or entity being investigated. It also contravenes regulatory expectations that investigations be thorough and based on substantiated evidence, not conjecture or statistical correlations alone. Another incorrect approach is to dismiss the behavioral indicators entirely without further investigation. While it is crucial not to jump to conclusions, ignoring potentially significant behavioral patterns that are statistically linked to fraud could lead to missed opportunities for detection and prevention. This passive stance could be seen as a failure to exercise due diligence in protecting the insurer's assets and upholding its commitment to combating fraud. The professional decision-making process for similar situations should involve a tiered approach. First, acknowledge and document the behavioral indicators identified through performance analysis. Second, assess the strength and reliability of these indicators based on established fraud detection models and historical data. Third, develop a plan for further, objective investigation to corroborate or refute the initial behavioral suspicions. This plan should focus on gathering specific, verifiable evidence related to the insurance claim or policy in question. Fourth, consult with relevant stakeholders, such as legal counsel or senior management, as the investigation progresses and evidence is gathered. Finally, ensure all actions taken are in strict accordance with the applicable regulatory framework and ethical guidelines, prioritizing fairness and due process throughout the investigative lifecycle. Question 15. Implementation of a comprehensive strategy to combat auto theft rings by an insurance fraud analyst requires careful consideration of regulatory compliance. Which of the following approaches best aligns with the regulatory framework and ethical guidelines for insurance fraud investigation? Option A. Conduct independent surveillance of suspected individuals and vehicles involved in potential auto theft rings, gathering evidence without direct involvement of law enforcement until a significant amount of data is collected. Option B. Share anonymized claims data with third-party data analytics firms that specialize in fraud detection without explicit regulatory approval or established data sharing agreements. Option C. Focus solely on identifying and flagging suspicious claims within the company's internal system, assuming that other agencies will handle external investigations and reporting. Option D. Proactively analyze internal claims data for patterns indicative of organized auto theft, document findings, and report suspicious activities through designated channels to regulatory authorities and law enforcement, as per established protocols. Correct answer is D. Proactively analyze internal claims data for patterns indicative of organized auto theft, document findings, and report suspicious activities through designated channels to regulatory authorities and law enforcement as per established protocols. Explanation: this scenario is professionally challenging because it requires an insurance fraud analyst to navigate the complex interplay between internal company policies, external regulatory requirements, and the practical realities of investigating organized auto theft rings. The analyst must balance the need for thorough investigation with the imperative to comply with all applicable laws and guidelines, ensuring that evidence is gathered legally and ethically. A misstep in this process could compromise the investigation, lead to legal repercussions for the company, and undermine the analyst's professional credibility. The correct approach involves a proactive and collaborative strategy that leverages regulatory frameworks and established investigative protocols. This approach is right because it prioritizes adherence to the specific regulatory framework governing insurance fraud investigations within the relevant jurisdiction. By focusing on identifying patterns of suspicious activity that align with known auto theft ring methodologies, and then reporting these findings through the designated channels as mandated by regulatory bodies, the analyst ensures that the investigation is conducted within legal boundaries. This also involves cooperating with law enforcement agencies as required by law and company policy, which is crucial for dismantling organized criminal enterprises. This method upholds the integrity of the investigation and ensures that any subsequent legal actions are built on a solid foundation of compliant evidence gathering and reporting. An incorrect approach that focuses solely on internal data analysis without considering external reporting mandates fails to meet regulatory obligations. Such an approach might identify suspicious patterns, but would neglect the legal requirement to report potential fraud to the appropriate regulatory authorities or law enforcement, thereby hindering the broader fight against insurance fraud. Another incorrect approach that involves directly confronting suspected individuals without proper legal authorization or coordination with law enforcement is highly problematic. This can jeopardize the investigation by tipping off the perpetrators, lead to the destruction of evidence, and expose the analyst and the company to significant legal liability for unlawful actions or potential accusations of entrapment. A third incorrect approach that involves sharing sensitive investigative data with unauthorized third parties, even if they appear to be assisting in the investigation, violates privacy laws and confidentiality agreements. This can compromise the integrity of the investigation, expose the company to data breach liabilities, and undermine trust with regulatory bodies and law enforcement partners. The professional decision-making process for similar situations should involve a thorough understanding of the relevant regulatory framework, including reporting requirements and data privacy laws. Analysts should always prioritize legal and ethical conduct, consult with legal counsel when in doubt, and maintain open communication with supervisors and relevant external agencies like law enforcement. A systematic approach that involves identifying red flags, documenting findings meticulously, and following established reporting protocols is essential for effective and compliant fraud investigation. Question 16. Which approach would be most appropriate for a certified insurance fraud analyst, CIFA, when initial evidence suggests a policyholder may be exaggerating the extent of damage to their vehicle following a collision, potentially leading to an inflated insurance claim, and the analyst has a professional obligation to investigate, but also to maintain client confidentiality and avoid prejudicing any potential future legal proceedings. Option A. Immediately contact the policyholder to discuss the discrepancies and request further documentation to clarify the extent of the damage. Option B. Discreetly gather additional evidence, such as independent repair estimates or photographic records from the scene, and consult with the claims supervisor and legal counsel before proceeding with any direct contact or further action. Option C. Close the claim file without further investigation, assuming the policyholder is acting in good faith until definitive proof of fraud is presented. Option D. Share the suspicions with other insurance adjusters in the area to see if they have encountered similar claims from the policyholder. The correct answer is A. Immediately contact the policyholder to discuss the discrepancies and request further documentation to clarify the extent of the damage. Explanation. This scenario presents a professional challenge because it requires an analyst to balance the duty to investigate potential fraud with the obligation to maintain client confidentiality and avoid prejudicing an ongoing investigation. The analyst must act ethically and within the bounds of regulatory requirements, which often dictate how information can be shared and used. Careful judgment is required to ensure that any actions taken are both effective in uncovering fraud and compliant with legal and ethical standards. The correct approach involves discreetly gathering further evidence and consulting with the appropriate internal stakeholders, such as a supervisor or legal counsel, before taking any action that could alert the suspect or compromise the investigation. This approach is correct because it adheres to the principles of due diligence and procedural fairness. It allows for a thorough and systematic investigation, minimizing the risk of wrongful accusation or premature disclosure of sensitive information. Regulatory frameworks for insurance fraud investigation typically emphasize the importance of a well-documented and legally sound process, which this approach supports by ensuring all steps are taken with proper authorization and consideration of potential legal ramifications. An incorrect approach would be to immediately confront the insured with the suspicion of fraud based on the initial information. This is ethically and regulatorily unsound because it presumes guilt without sufficient proof and could lead to the destruction of evidence, the insured fleeing, or legal repercussions for the insurer due to premature accusation. Another incorrect approach would be to share the suspicions with other policyholders or external parties without proper authorization. This violates confidentiality agreements and can lead to defamation claims and damage to the insurer's reputation. Finally, ignoring the suspicious activity and failing to investigate further would be a dereliction of duty, potentially allowing fraud to continue and violating the insurer's obligation to its stakeholders and regulatory bodies to prevent and detect fraudulent claims. Professionals should approach such situations by first recognizing the need for a structured investigation. This involves documenting all findings, assessing the credibility of the information, and identifying potential red flags. The next step is to consult internal policies and relevant regulations to understand the permissible actions. Seeking guidance from supervisors, legal departments, or specialized fraud investigation units is crucial. This collaborative approach ensures that decisions are informed, compliant, and strategically sound, protecting both the insurer and the integrity of the investigation process. Question 17. The analysis reveals that a significant portion of reported insurance claims exhibit characteristics that could be indicative of fraudulent activity, but the underlying reasons for these actions vary widely among individuals. Which of the following analytical approaches best addresses the motivations behind insurance fraud to inform effective prevention and investigation strategies? Option A. Prioritizing the identification of claims with the highest potential financial loss and focusing investigative resources exclusively on these cases. Option B. Implementing stricter policy clauses and increased penalties across all policy types to deter any potential fraudulent activity through a generalized deterrent effect. Option C. Relying solely on advanced statistical algorithms to flag anomalies in claim data, assuming that any deviation from the norm represents fraudulent intent. Option D. Developing a comprehensive understanding of the psychological and economic factors that compel individuals to engage in fraudulent behavior, and using this insight to refine detection models and communication strategies. The correct answer is A. Prioritizing the identification of claims with the highest potential financial loss and focusing investigative resources exclusively on these cases. Explanation. This scenario is professionally challenging because it requires an analyst to move beyond simply identifying potential fraud indicators to understanding the underlying human behavior and economic pressures that drive individuals to commit insurance fraud. Nuanced understanding of motivations is crucial for developing effective fraud prevention strategies and for conducting thorough investigations that consider the full context of a claim. The Certified Insurance Fraud Analyst (CIFA) designation implies a need for this deeper analytical capability, going beyond surface-level detection. The correct approach involves recognizing that insurance fraud is often a complex interplay of perceived opportunity, financial pressure, and rationalization. Understanding these motivations allows for more targeted investigations and the development of proactive measures that address the root causes. For instance, identifying a pattern of opportunistic fraud might lead to enhanced policy wording or clearer communication of policy terms, while understanding financially motivated fraud might inform strategies for detecting early warning signs of financial distress in policyholders. This approach aligns with the ethical obligation to conduct investigations with integrity and to contribute to the overall stability of the insurance market by mitigating fraud effectively. An approach that focuses solely on the financial loss without considering the motivations behind the fraud is incomplete. While financial loss is a direct consequence, ignoring the why can lead to ineffective countermeasures. For example, simply increasing penalties might not deter someone driven by desperation. This fails to leverage the full analytical toolkit expected of a CIFA. Another incorrect approach is to assume all fraud is malicious and premeditated. While some fraud is, many instances stem from a perceived justification or a gradual slide into fraudulent behavior. Failing to differentiate these motivations can lead to misdirected investigative efforts and potentially alienate honest policyholders. This overlooks the ethical consideration of treating all individuals with a degree of fairness and avoiding prejudgment. Furthermore, an approach that relies solely on statistical anomalies without attempting to understand the human element behind those anomalies is insufficient. While data analysis is critical, it should inform, not replace, the understanding of human behavior. This approach risks missing fraudulent schemes that don't fit predefined statistical models, or misinterpreting legitimate but unusual circumstances as fraudulent. Professionals should adopt a decision-making process that integrates data analysis with an understanding of behavioral economics and psychology. This involves 1. Identifying potential fraud indicators through data. 2. Investigating the context and potential motivations behind these indicators. 3. Developing hypotheses about the type and extent of fraud based on motivational understanding. 4. Tailoring investigative strategies and prevention efforts to address specific motivational drivers. This holistic approach ensures a more effective and ethically sound response to insurance fraud. Question 18. The monitoring system demonstrates a pattern of high billing for durable medical equipment, DME, and physical therapy sessions for a specific patient cohort. As a certified insurance fraud analyst, which of the following actions would be the most appropriate initial step to investigate potential unnecessary services and equipment? Option A. Immediately flag all claims associated with this patient cohort for potential fraud due to the high billing volume. Option B. Consult with other analysts to gather anecdotal information about the providers involved before proceeding with any investigation. Option C. Initiate a broad audit of all DME providers and physical therapy clinics that serve this patient cohort, regardless of individual claim details. Option D. Review the medical necessity documentation for the billed DME and physical therapy sessions for each patient within the cohort, cross-referencing with their diagnoses and treatment plans. The correct answer is A. Immediately flag all claims associated with this patient cohort for potential fraud due to the high billing volume. Explanation. This scenario is professionally challenging because it requires an analyst to distinguish between legitimate medical necessity and potential overutilization or fraud, particularly when dealing with services and equipment. The core difficulty lies in interpreting complex medical documentation and billing codes within the specific regulatory framework of the Certified Insurance Fraud Analyst (CIFA) exam, which implies a focus on U.S. state and federal insurance laws and regulations. A careful judgment is needed to avoid both wrongly accusing legitimate providers and missing fraudulent schemes. The correct approach involves a thorough review of the patient's medical records, the treating physician's documentation, and the billed services and equipment against established medical necessity guidelines and payer policies. This approach is right because it directly addresses the potential for unnecessary services and equipment by seeking objective evidence of their medical appropriateness. Specifically, it aligns with regulatory requirements that mandate insurers to pay for services that are medically necessary and reasonable. By cross-referencing the billed items with the patient's condition, treatment plan, and industry standards, the analyst can identify discrepancies that may indicate fraud, waste, or abuse, thereby fulfilling their duty to investigate potential violations of insurance laws and regulations. An incorrect approach that focuses solely on the volume of services or equipment billed, without considering medical necessity, is professionally unacceptable. This failure stems from a lack of due diligence and a misunderstanding of what constitutes fraudulent billing. Regulatory frameworks, such as those governed by the Centers for Medicare and Medicaid Services, CMS, and state insurance departments, emphasize medical necessity as the primary determinant of payment. Simply flagging high billing volumes without this critical context can lead to erroneous accusations and damage professional relationships. Another incorrect approach that involves immediately flagging all services and equipment exceeding a certain dollar threshold, irrespective of the patient's condition or the nature of the service, is also professionally flawed. This method is arbitrary and fails to consider the inherent variability in healthcare needs. It ignores the fundamental principle that the appropriateness of a service or equipment is tied to the patient's specific medical situation, not a predetermined monetary limit. Such an approach can lead to the overlooking of genuine fraud in lower-cost services while unfairly scrutinizing legitimate, albeit expensive, treatments. A third incorrect approach that relies on anecdotal evidence or industry gossip to identify potentially unnecessary services and equipment is ethically and regulatorily unsound. Professional investigations must be based on objective data and verifiable facts. Relying on hearsay or unsubstantiated claims undermines the integrity of the investigation process and can lead to biased conclusions. Insurance fraud analysis is governed by strict evidentiary standards, and decisions must be supported by documented evidence and adherence to established investigative protocols. The professional decision-making process for similar situations should involve a systematic, evidence-based approach. This begins with understanding the specific allegations or red flags identified. The analyst must then gather all relevant documentation, including medical records, billing statements, and payer policies. A critical step is to compare the billed services and equipment against the patient's medical condition and the treating provider's documented rationale for their use. This comparison should be guided by established medical necessity criteria and relevant regulatory guidelines. If discrepancies are found, further investigation, which may include consulting with medical experts or reviewing additional patient history, is warranted. The ultimate determination of fraud or overutilization must be based on a comprehensive analysis of all gathered evidence, ensuring compliance with all applicable laws and ethical standards. Question 19. Process analysis reveals a business interruption claim filed by a restaurant following a fire that damaged its kitchen. The insured claims significant lost profits and ongoing expenses for a period of 6 months, citing extensive repairs and loss of customer goodwill. The analyst is tasked with evaluating the validity and accuracy of this claim. Which of the following investigative approaches best aligns with the principles of sound claims analysis and fraud detection within the U.S. regulatory framework for insurance fraud analysts? Option A. Accept the insured's submitted profit and loss statements for the period of interruption as accurate and proceed with calculating the indemnity based on these figures. Option B. Rely solely on the insured's verbal assurances regarding the extent of their losses and the necessity of the prolonged closure. Option C. Conduct a thorough review of the insurance policy to confirm coverage for the peril. Meticulously analyze the insured's pre-loss financial statements and tax returns to establish a baseline for lost income, and verify the insured's documented efforts to mitigate business interruption. Option D. Immediately flag the claim for potential fraud based on the extended duration of the claimed interruption and the high dollar amount, without further detailed investigation. The correct answer is C. Conduct a thorough review of the insurance policy to confirm coverage for the peril. Meticulously analyze the insured's pre-loss financial statements and tax returns to establish a baseline for lost income, and verify the insured's documented efforts to mitigate business interruption. Explanation. This scenario is professionally challenging because it requires an analyst to distinguish between a legitimate business interruption claim and one that may be inflated or fabricated, all while adhering to the specific regulatory framework governing insurance fraud investigations in the United States, as relevant to the Certified Insurance Fraud Analyst CIFA exam. The analyst must balance the insurer's obligation to indemnify a covered loss with the responsibility to prevent fraudulent payouts, necessitating a thorough and objective investigation. The correct approach involves a systematic and evidence-based review of the business interruption claim. This includes meticulously examining the policy wording to confirm coverage for the declared peril, scrutinizing the insured's financial records to establish a baseline of pre-loss earnings, and to accurately calculate the period of lost income, and verifying the insured's efforts to mitigate their losses. This approach aligns with the principles of fair claims handling and investigative due diligence mandated by state insurance regulations, which require insurers to conduct investigations in good faith and without undue delay, while also preventing the payment of fraudulent claims. The CIFA designation implies a commitment to these standards. An incorrect approach that focuses solely on the insured's stated losses without independent verification would be professionally unacceptable. This failure to conduct due diligence could lead to the payment of fraudulent claims, violating the insurer's fiduciary duty and potentially contravening state laws that prohibit unfair claims settlement practices. Another incorrect approach, which involves immediately denying the claim based on suspicion without sufficient evidence, would also be professionally unsound. This could expose the insurer to allegations of bad faith claims handling, potentially violating state insurance statutes that require claims to be investigated thoroughly and paid promptly when coverage is established. A third incorrect approach, which involves accepting the insured's documentation at face value without cross-referencing or seeking independent corroboration, demonstrates a lack of investigative rigor. This oversight could result in the payment of inflated claims, thereby contributing to insurance fraud and undermining the integrity of the insurance system, which is contrary to the ethical obligations of a fraud analyst. The professional decision-making process for similar situations should involve a structured, multi-stage investigation. This begins with a thorough understanding of the policy and the claimant's reported loss. It then progresses to gathering and analyzing all relevant documentation, conducting interviews, and seeking independent verification where necessary. Throughout the process, the analyst must maintain objectivity, document all findings meticulously, and adhere strictly to applicable laws and ethical guidelines. Question 20. The audit findings indicate a pattern of inflated repair costs and slightly exaggerated personal injury claims across several recent motor insurance policies. In one instance, a claimant reported a pre-existing minor injury that was significantly amplified in its description and impact on their ability to work, leading to a higher payout than warranted by objective medical assessments. In another, a vehicle repair invoice presented by a claimant included charges for services not rendered, though the claimant stated they simply submitted the invoice provided by the repair shop without scrutinizing its details. Based on these findings, which of the following represents the most appropriate initial classification and investigative approach for the analyst? Option A. Classify both instances as soft fraud, advising the policyholders to resubmit corrected claims and issuing a warning for future policy adherence. Option B. Classify the amplified injury claim as potential soft fraud and the inflated repair costs as potential hard fraud, requiring separate, intensive investigations into intent for each. Option C. Classify both instances as hard fraud due to the presence of inflated costs and amplified injury claims, and immediately initiate legal proceedings. Option D. Classify the amplified injury claim as potential soft fraud and the inflated repair costs as potential hard fraud, focusing initial investigation on gathering evidence to prove intent for both. The correct answer is C. Classify both instances as hard fraud due to the presence of inflated costs and amplified injury claims, and immediately initiate legal proceedings. Explanation. This scenario is professionally challenging because it requires the analyst to distinguish between intentional misrepresentation and potentially unintentional oversights or exaggerations within the context of an insurance claim. The core difficulty lies in the subjective nature of soft fraud and the need to gather sufficient evidence to prove intent, which is a key differentiator from hard fraud. Careful judgment is required to avoid misclassifying actions and to ensure that investigations are proportionate and evidence-based, adhering strictly to the principles of fairness and due process. The correct approach involves a thorough investigation to determine intent. This means gathering all available evidence, including policy documents, claim forms, witness statements, and any third-party reports, to establish a clear pattern of deception or material misrepresentation. The analyst must then assess whether the evidence points to a deliberate attempt to mislead the insurer for financial gain, which would constitute hard fraud, or if it suggests exaggeration or omission that, while improper, may not meet the threshold of criminal intent, thus falling under soft fraud. This meticulous, evidence-driven approach aligns with the ethical obligation to conduct investigations impartially and to uphold the integrity of the insurance process, ensuring that only substantiated allegations of fraud are pursued. An incorrect approach would be to immediately classify any exaggeration or omission as hard fraud without further investigation into intent. This fails to recognize the distinction between soft and hard fraud and can lead to unwarranted accusations and potential legal repercussions for the insured. It bypasses the crucial step of proving deliberate deception, a fundamental requirement for establishing hard fraud. Another incorrect approach would be to dismiss all instances of exaggeration or omission as mere soft fraud, without considering the potential for deliberate intent. While some instances might indeed be soft fraud, a failure to investigate further could allow significant fraudulent activity to go undetected, undermining the insurer's financial stability and potentially enabling further fraudulent claims. This approach neglects the analyst's duty to thoroughly investigate all suspicious claims. A third incorrect approach would be to focus solely on the financial impact of the misrepresentation, regardless of intent. While financial impact is a factor in assessing the severity of fraud, it is not the sole determinant of whether an act constitutes hard or soft fraud. Hard fraud requires proof of intent to deceive, which is distinct from the monetary value of the fraudulent claim. The professional decision-making process for similar situations should begin with a comprehensive review of the claim and supporting documentation. The analyst should then identify any discrepancies, exaggerations, or omissions. The next critical step is to gather additional evidence to ascertain the insured's intent. This involves looking for patterns of behavior, inconsistencies in statements, and any corroborating evidence that supports or refutes the insured's claims. If evidence of deliberate deception is found, the case should be classified as hard fraud. If the evidence suggests exaggeration or omission without clear intent to defraud, it should be classified as soft fraud, with appropriate actions taken based on policy terms and regulatory guidelines for such cases. Throughout the process, maintaining objectivity and adhering to established investigative protocols are paramount.